They say what goes up must come down. But for medical device giant DexCom, whose stock just plunged, it feels less like gravity and, well, more like someone just cut the cable on the elevator. Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today, using data captured this morning, September 22, 2025, we are diving deep into the medical device maker DexCom, ticker DXCM. We want to figure out if this steep drop is, a disaster or maybe a genuine deep discount.
Yeah, and before we get right into DexCom itself, we should probably set the scene a bit. The macro environment isn't exactly helping. The general market mood is, well, cautious. Futures for the S&P 500, the NASDAQ, the Dow, they're all pointing a bit lower this morning. Plus, you've got a whole lineup of Fed officials speaking today, and that always makes the market a little jittery. So DexCom's already swimming upstream, you could say.
Okay, right. So against that backdrop, let's unpack the core catastrophe here. DexCom took an 11% nosedive last Friday. That's huge. And the trigger, an investigative report. It's alleging pretty serious safety issues, and this seems key unauthorized changes to their main product, the G7 device.
Exactly. And what's really fascinating when you look at our research is that this crisis hit a stock that, frankly, already looked significantly overvalued. Our fair value analysis, just based on cash flow projections, puts DexCom's intrinsic worth somewhere between, say, $57 and $61 a share. But it was trading near $67 before this news broke.
Wait a second, so you're saying even before this really damaging safety news came out, our research showed the market had DexCom valued, what, $10, maybe $15 higher than its fundamentals suggested. So this news didn't just cause a drop, it kind of popped an existing bubble.
It certainly looks that way.
And then, to make matters worse, the CEO announces he's taking a temporary medical leave right at the same time. Talk about bad timing. A leadership vacuum, right when investors need reassurance.
Precisely. And this creates a real conflict, doesn't it? Do you trust the market's obvious panic, or do you look at the institutional view? Because here's the striking contradiction. Our research shows an overwhelming 85% of Wall Street analysts still rate DXCM a buy or even strong buy. So the market's running for the door, but the analysts, publicly anyway, are telling everyone to stay put. It's confusing.
Okay, if the analysts are sending mixed signals, let's see what the traders are actually doing. How intense is the fear right now? Let's check the sentiment. The options market is practically screaming panic. We're seeing a put-to-call ratio of 2.21. That means for every optimistic bet the stock goes up, there are more than 2 pessimistic bets it's going down. That's a really high level of fear.
It really is.
And on top of that, short sellers. About 3.6% of the available shares are being shorted. That's a pretty clear vote of no confidence from that segment of the market.
And the technical charts, they absolutely confirm this stampede for the exits. The shorter-term trend has just sliced right down through the long-term trend. In plain English, that strong upward path the stock was on, it's officially broken. Now it's heading down, and fast.
And that 10% collapse wasn't on light volume, right?
Not at all. It happened on a massive surge in trading activity. That confirms it was high-conviction selling. Big players wanted out. It wasn't just a quiet drift lower.
Right, and the momentum?
Gone. Evaporated. And it's actually accelerating downwards pretty aggressively now.
Okay, so you connect that collapsing momentum with the volatility, which you said exploded.
Exactly. Volatility absolutely exploded during the decline. That combination, falling momentum, spiking volatility, it's textbook market panic.
Wow. It's like hitting severe turbulence and the engine's cutting out all at once. That's what the charts are showing us.
That's a good way to put it. So if we pull back and look at the whole picture for a bearish outlook, you've got the negative macro mood, you've got this catastrophic product news, the stock was already overvalued, you add in the really fearful sentiment we just talked about, and a complete breakdown on the technical charts. The evidence pointing downwards is pretty overwhelming right now.
So, okay, what does this mean practically for investors looking at this? Where are the key levels?
Well, it looks like sellers are firmly in control as long as the stock stays below $66.90. That's the line in the sand for now. If buyers want to even attempt a recovery, they really need to push it back up and reclaim the $70 level.
And for this whole bearish idea to be wrong?
You'd need to see a really powerful rally, something that takes the stock back above $75 and closes there convincingly. That would invalidate the current bearish setup.
Got it. But we should quickly mention the risks to being bearish here, right? There are always risks.
Of course. 3 main ones jump out. 1, the stock is technically oversold after such a sharp drop, which can sometimes lead to a short-term bounce. 2, the company could come out with a really strong, convincing rebuttal to that investigative report. That could change sentiment quickly. And 3, maybe those bullish analysts are right, and big institutions decide to keep the faith and buy the dip, ignoring the current panic.
Those risks are definitely there. But as you said, the weight of the evidence right now seems pretty heavy on the downside.
It certainly does.
It really seems DexCom's G7 device might have caused a, well, G-force-like drop in its own stock price. For now, this looks like a falling knife, and probably far too dangerous to try and catch. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.